Hi, I'm Peter Rose, founder of Longwood Currency Trading. Thoughts on staging out of a large FOREX position. When you have the ability to trade multiple lots, and again, these are based on my parameters of risk management for trading. When you're capable, even though you're trading maybe 3 or 5 full lots, I think you should be an all-in, all-out trader. You go all in with your load and you come all out at the end. You should be breaking them up into building or staging into positions, and certainly not staging out of positions. But when you're trading with larger lot size, you're faced with those considerations, and I've done quite a few videos on trading large lot size positions. Or for the retail trader, when you get up around 10 lots, that's a lot of lots to be trading. As long as you're trading at reasonable leverage. I mean, any damn fool can trade 20 lots on a $10,000 account at 200 to 1. I mean, I don't think you're a trader then. I think you're stepping up to the craps table and just doing whatever you're going to do. Because trading is a skilled profession, you're going to end up ultimately losing. Now, you may make $60,000 or $70,000 on your $10,000 or $20,000 account, but you'll eventually flush it all out because you don't know what you're doing. That's the problem in viewing trading and listening to some of the stuff that's out there. However, when you do have the ability to trade multiple lots, to the extent where you are building positions and staging into them, as I've discussed in quite a few of my videos, you'll note that I don't discuss staging out of positions. There's some large traders that say it never hurts to ring the cash register and peel some of your lots off when it reaches a certain point. Let's say you're floating a 20 lot position or a 10 lot position, and you get 10 pips into a 20 pip sojourn up, 10 pips in to a 20 pip profit target, and you decide you'll take half your position off. So you've got 10 lots, you pull 5 off, and you let the other 5 ride. That's staging out. And I'm not a proponent of that. I have done it in the past. I know what happens from a mathematical standpoint, and I'm not real happy with that. When let's say you have 10 lots, you've reached 10 pips in profit. You've got a $1,000 gain there, right? You're $100 a pip. So you have $1,000 gain. You have a 20 pip profit target, which is going to be a $2,000 gain. What happens when you pull 5 lots off? So if you peel that 5 lot off and let the remaining 5 go, you get $1,500 profit by doing that. Whereas if you'd let all 10 go to you'd have $2,000 profit. That's 25% loss of potential profit that you've taken. But you risk 10 lots, but you only fulfill the obligation with half of them. So the math just is upside down on staging out. If you look at the staging in process, it's exactly the opposite to that, where you're adding to that position. Now, you can add stupidly by reverse pyramiding, or you can do it smart, and how you break that up and how you stage in, how far apart are the stage points, what size lot size do you continue to stage in with, all that sort of stuff. There's a lot more theoretical validity for staging in than there ever could be for staging out. Look, if you are carrying a 10 lot position and you want to ring the cash register at 10 pips or halfway to your profit target, what does that say? It says that you are unsure of your entry analysis that said, oh, here's a 20 pip potential profit target. why would you take 5 off at the 10 pip point? If you don't have any confidence that the price is going to go on, why would you clip yourself by taking 5 off and risking the other 5? But you're sort of looking negatively at your trading as opposed to looking positively. If you have a positive expectation that results from your entry analysis and the conditions indicate that your profit target is here, then is it reasonable that you're going to get to your profit target? Well, probably not most of the time. But certainly to clip it halfway just to ring the cash register is not a valid reason in my mind for clipping your profits by 25%. Just to ring the cash register. From a mathematical standpoint, it doesn't make anywhere near the sense that staging in does. And if you clip your, let's say you've staged into that position to the 10 lot level at 10 pips, and now you peel 5 off. You're peeling 5 off from the initial lots that you put on, not the latter lots. You don't get to pick. It's a FIFO rule. It's a accounting rule. It's a law. Some of you guys in foreign countries aren't faced with that. If you're in the United States and you're listening to these guys who are targeting the lots that they want to pull off, you can't do that in the United States and in many of the other advanced countries. It's an accounting rule, and you should study it and learn it. If you don't know what you're doing, you shouldn't be trading currencies. And there's a reason for that rule. And just because you live in a country that allows you to cherry pick your lots that you're going to pull off doesn't mean that that's a good thing. The FIFO rule was put into place for a specific reason. If you don't understand that reason, then you're going to poop on it, and you're going to say, well, I can pull off any lot that I want to. Okay, go to it. So I guess my caution to you would be, if you're cutting your profit potential in half, it would indicate that you're unsure of your entry analysis. If you're unsure of your entry analysis, then you shouldn't be making the trade. That's my thought about it. And that certainly simplifies things. If I'm not willing to carry my position and get at least, price would go at least 3/4 of the way to the profit target before it ran into some kind of jam, then I really haven't evaluated price action reasonably well. And so the issue isn't, oh, I'm going to ring the cash register and I'll make X amount of dollars. Because if you're doing that, then you're taking double the risk all the time to clip your profits by or the pip to profit target in half and losing 25% of your profit targets. If you continuously do that as a mantra of trading, you're going to find yourself almost jump ball trader. And if you're not a real good trader, you're not going to be making any money at 50-50. You have to be really, really, really good as a 50-50 trader to make money. Now, you could be a scalper and be under a 50-50 trader and make a lot of money. But then 90% of traders fail, and 90% of scalpers, 90% of the 10% remaining successful traders that are scalpers, and 90% of those fail. Scalping is a very difficult process. And it isn't like you see these guys say, well, I only take one trade a day and I get my 10 pips and I'm out. No, 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 no. If you're a scalper, you're scalping 5, 10, 50 times a day. You're banging away at that. You're picking up a half a pip and 3/4 of a pip and all that. And the problem with scalping in the currency market is the VIG that we pay, which is the spread. So when you're scalping, you have to be really, really good to beat the odds and to beat the VIG. You can't say I'm a scalper and I'm looking for 5 or 8 pips when I go in to make a trade. That's not scalping, that's day trading. And as a day trader, you can make 4, 5, 6 trades a day. That's not a lot of trades if you're going to sit there for 2 or 3 hours. If you're working with large lot sizes, you may be probing the market with 3 lot positions until you finally find your sweet spot in that price action, and then you start to stage into it. So your win-to-loss ratio is going to be very, very poor, quote, as opposed to when you're an all-in, all-out trader. You really have to have a sense of where you're at in your ability to evaluate these potential profit targets. You can't just throw a dart against the chart and say, okay, I think that looks like a pretty good spot that it's going to go there. There have to be conditions that state that it's going to go there. And if you become convinced that it's going to go there, and you're staging in with these larger lot sizes, you're staging into that position, I mean, you're not going to get your full load in until you're out 10 pips or so. So you have to be really confident that your 30 pip or so profit target is reasonable when it's not reasonable that you're going to have 30 pips potential there. More often than not, you're looking at 15 to 25 pips as a solid profit target. And I'm talking in the majors. You can't have some currency that has an ATR of 20 pips on a 5-minute chart, let's say, and expect that you're going to be able to weather the drawdowns. You have to be trading the majors where there's lots of liquidity and you don't have those spikes. It's bad enough, I mean, on a pound-dollar pair that I trade quite a bit, for example, I've seen 50 pip 5-minute pin bars. Saw one the other day. 15-minute pin bars, or even just candles at 80 pips, 90 pips, when the ATR, the daily ATR, is 80 to 110 pips. So you have to be talking the same lingo that I am and understanding the rationale behind what I do and why I would say that, gee, it's probably not a good idea from a theoretical standpoint or a practical standpoint to be pulling lots off of your position because that doesn't demonstrate entry confidence, nor does it indicate that you have an understanding when you get into the larger lot size positions where you've staged into a position. It doesn't really indicate that you understand the mathematics behind what happens when you pull lots off if you're in a FIFO accounting rule conundrum. So just be aware of you not only have to be aware of the rules of the market and trading and price action, but you have to be aware of the rules that the countries allow you to trade in. If you're in some broker that's giving you 500 to 1 with no margin, I mean, that's just a recipe for disaster. So if you bring everything and ratchet it all down into reasonable trading levels, and look, you can rail against the American system that requires that if you're going to be what's called a patent day trader, you're going to make so many trades in a week's period of time. You have to have a $25,000 balance in order to do that. So if you think you're going to get in and trade stocks on a $3,000 or $5,000 account, you're wrong. You might be able to make 7 trades a week or something like that, but you're not going to trade. You're going to have to invest. You can invest with $500, but you're not going to trade. So is that a good thing or a bad thing? Why did they come up with the patent day trading rule where you have to have the $25,000? That would seem to be just a stupid, stifling against the trader. It's to protect the trader from themselves, because the people that are forming the rules know more about the dangers of this stuff than the retail trader does. And that's the case as the United States commissions, commodity exchange commissions, and all the other commissions that deal with trading rules for Forex, for commodities. Commodities, the lock limit rules, they're deadly if you get caught in them. Stock market has a downtick rule for no sell. You can't argue against that stuff. Those rules are there to help protect you as a trader so that you don't destroy yourself. In the process of whether you're going to stage out of a position or not out, nobody cares. But if you look at the math behind it, it doesn't make any sense. The only sense that it makes is that you really are not confident in your entry analysis and you're going to take half the trade off. In my view, if the position gets out to a certain point where it starts to look like it's weak, or it looks like it could potentially not get to where you thought it was going to go, I'm going to take the whole thing off the table. I'm not going to take half of it off. It just doesn't make any sense to do that from my standpoint. So it's simply an opinion based on my knowledge of the mathematics of how this stuff goes together, that it's probably not a good idea to stage out of a position. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.